Hello, folks. Welcome to Pro Trader Strategies Market Commentary. We are an educational company, so if you want to learn about trading, markets, and options, please hit that subscribe button so that you guys get notifications. Also, if you have any questions, comments throughout this video, please hit me up over there in the questions, comments box. Even if you're watching this on tape delay or watching it a little bit later on today, I'm going to be circling back around and make sure that I answer everybody's questions and make sure you're all clear of concept today. All right. So finally, smash that like button. It really does help us out. So as I mentioned in this video, we're going to talk about the economic data, how it's impacting the overall markets. And then finally, we're going to try and find some strategies or some option strategies that we can implement into our portfolio based on those assumptions. All right. I'm Eric Wilkinson, and yes, you very well may recognize me from mainstream media. Without further ado, let's get on with the economic data. Across the pond, we got the flash estimates for the CPI. Now, I'm going to breeze over this because tomorrow we get the real numbers here in the PMI, all right? These are older. We want to look at the PMI, which is the Purchasing Managers Index, to see what type of inflation aspects they're feeling in the CPI numbers across the pond, even the core CPI number, what the consumer is feeling or broader consumer is feeling in line with expectations. But like I said, tomorrow we're going to be really keeping our eyes out for that. Bostic speaking today, as I told you, almost every Fed governor here and even monetary policy members across the pond are speaking today. Here we got the ADP non-farm payroll. This is ahead of Friday's unemployment number, which is going to be the real number we look at. It comes out at the first Friday of every month. Well, this is going to be a little bit of an indication there. Hiring, 692,000 hires, almost 700,000. It was expected to only be 555,000. Now, keep in mind, they did revise last month's number down almost 100,000. So yes, we beat by well over 100,000 on the headline number, but they revised down by quite a bit on the back end. So not going to be as pretty a look as what we would have expected, but it's still a lot better than what anybody probably thought was going to be coming out or down the pipe. All right. Chicago PMI, which is Purchasing Managers Index. This is the guys that are seeing the demand from you and I, the consumers. And that came in at 66.1, lower than the expected 70. Now, keep in mind, anything above 50 is expansion, so that's good to see. And then we also got pending home sales, knocking it out of the park, up 8%, expected to be down 1.1. We've been seeing these home sales start to dwindle a little bit, trying to really figure out what's going on here with this 20, I think it's inventories are like down 21%. Home prices increased by another 14%. Now, put this all into perspective, folks. When we're talking about home prices, last year, this time, home prices were running right around $300,000 per house, basically. So that was the average across the board. It was $295 last year, June. This latest reading, 360,000 is the average. So a massive 20% increase basically over a year. Now, there are certain sectors that are doing very well. Phoenix is doing very well as one of the biggest increases. But across the board, an amazing amount of value or creation of value through these homes. Is it a bubble? Well, think about this last year at this time. People were in lockdown and doing things to their homes, maybe even doing this urban sprawl where they were buying out into the suburbs. But people that already had their homes were stuck at home, were building out their offices. I talked about this all last year, folks, and improving the home if they didn't move, maybe even putting in a pool. That's increasing the value of those homes as well. So they're keeping up with this inflationary aspect of the homes because they're actually putting money into them. And that's increasing prices as well. I don't think that's as bad as a bubblicious type of housing boom here. And then finally, we got crude oil inventories, a drawdown of 6.7 million barrels, expected to be a drawdown of 4 million. I can't expect that they would thought it was going to be much bigger than that. But what we can see happening over here in the, let me just double check here, make sure I do this. There we go. The crude oil coming off a little bit off the highs after that number. we're seeing some decent demand here across the board in the manufacturing sector. Is the consumer going to be able to keep up with that? We're seeing these drawdowns, but we're also not producing as much. I mean, Biden is probably the most anti-oil president we've probably ever seen, folks. So that is going to limit our production of oil going forward, which should limit supply, right? And if we're seeing this demand, we could continue to see crude oil moving higher. A lot of people calling for $100 a barrel. I don't want to see that, especially right now when we're seeing an economy trying to get out of this lull. You don't want the consumer spending $20 a week extra throwing it into a gas tank. You'd rather see them spend it somewhere else because that creates that velocity of money, folks, that we're looking for. All right, bonds moving higher. I told you the risk of the bonds is probably, if you are trying to play this to the downside, meaning if you think bonds are going to go down and interest rates are going to go higher, because remember, this is like a teeter-totter when we're talking about bonds and you hear these folks talking about interest rates. If you had a teeter-totter, right, we look at as bond prices, as price goes higher, meaning this price goes higher, right, then we see interest rates go down, all right? They're inversely correlated in the markets, all right? So right now with the bonds going up, we're seeing interest rates go down. That means lower interest rates. That's probably not necessarily asset buying from the Fed. Yes, they are supporting these levels. I don't think this move is necessarily based on that. It's really, I think, a snapback. People realizing, hey, the Fed, despite the fact that we've been calling for them to raise interest rates maybe a little sooner than later, they are not going to do that. They haven't even talked about slowing asset purchases really at all. And that's going to come probably at the beginning of 2022. The bonds moving higher. I don't think that they're going to be able to sustain much of a rally here, folks. I think bonds are going to get stuck in the mud right in and around this 160 handle that we were seeing there. All right, gold futures making a little bit of a move higher here. We've been seeing a little bit of dollar weakness lately. If it starts really imploding there, we could see another spike in gold. But at this point, not really seeing the inflationary pressures right now. They might be a little bit more transitory than I was even suggesting. So gold might be way ahead of that game as well. Bitcoin, we're coming off a little bit. There's just not a whole lot of catalyst to get this market moving. There needs to be a new fresh round of blood or something to come in here and drive this market higher. But at this point, these 3,500 or 35,000 area in Bitcoin really seems to be the sweet spot. At that point, it would be something where I would be, if you're into the options, looking at an iron condor or something around this, because I just don't really see it moving very far, very quickly. And we can see that volatility is relatively elevated for Bitcoin. So that would be an opportunity possibly for something like a neutral trade in the options. VIX, really not a whole lot to see here other than the fact that we want to stay in the teens. We dipped really low. We haven't seen the teens for quite some time, and I don't really want them coming back around. That, something to note, volatility has been driving this younger generation into investing. They have a higher risk tolerance, folks, because they have a much longer investment horizon. So they are looking at more risky assets. And that's kind of what's drawn them to the markets right now, is this high implied volatility that we've had this last year. Now, we don't want to see that dwindle up, because they're going to probably pull their money out of the markets that don't have volatility, find the markets that do have some volatility. That's another aspect why I'd like to see some volatility stay elevated in the markets for at least the remainder of the year. I'm a little bit biased because I like the volatility myself as well. All right, this sector rotation back and forth, I've talked about it for probably the last 6 months, that I think that 2021 is going to see this type of volatility where we get these rallies, sector rotations, tech sector, maybe a little bit frothy, and people pulling out of that sector rotation into maybe some of the blue chips like the Dow Jones Industrial Average. Well, we're seeing this happen almost daily, folks. So you need to be on your toes and staying mechanical with this. Stay on the longer term focus here, where I think that, we've been talking about this. Yeah, we might fit slightly higher on the year, but for the most part, we're going to end up at this relatively within, a few, maybe 5 percentage points of where we were at the beginning of the year, I think. I don't think we're going to see too much of a massive move to the upside for the remainder of the year. I think we're going to see this choppiness back and forth heading forward. All right, E-mini S&Ps yesterday making a new all-time high. Yeah, are we getting this topping pattern? We've got 3 of them if it finished like this today. Big settlement at the low of the wick today would be very toppy feeling and looking for a correction. Now that we've bumped up against this Fibonacci, which is the 150 extension, you can tell that's off of this line here. And it has acted as resistance in the past. Will we be able to settle above that? It is going to be needed really to keep those bulls out there. And these rallies, folks, especially in the tech sector, it just seems like a slow grind higher, and it's on low volumes. Remember, in the summer, we see these volumes kind of shutter a little bit. I think in June, we'll probably see this market continue to move a little bit higher, maybe grind on these lower volumes. But keep in mind, when we get these slow grinds on low volumes, the correction has a tendency to be a little bit more aggressive. All right. So that's why I've talked about this year, like we would like to see the markets kind of do these patterns where we boom, boom. That's a little bit more healthy than what we were seeing basically in 20. That's a little bit exaggerated, but last year it felt more parabolic. We need more corrections, pullbacks. That keeps people at bay. That keeps everybody not so antsy, all right? What I mean by that is when you have bought something and it is at all-time highs, there is a lot of angst there, right? What we try to do is stay mechanical here. Take all that emotion out of trading. I've talked about this time and time again, more probably so in my webinars, but I started out in college with a psychology degree. And to this day, I say that my psychology education is probably more beneficial than my financial education. Yes, I can read the numbers. And when I was on the floor, the guys down there used to ask me what the economic data really meant for the markets. But the psychology, keeping mechanical, keeping that emotion away from trading is key to longevity in this field. All right. So stay mechanical with this, keep your eyes on this line in the sand here. If we finish above yesterday's high or print a new high here and finish near those highs, it'll look like we're going to continue to grind a little bit higher here, but a settlement near that low or any kind of sell-off towards late in the day, that's going to mean that volume shortage is really going to start coming back to haunt us, sometime soon. All right, overnight inventory was pretty much short, but we flushed those guys out on the data. It was pretty decent data. Maybe the Chicago PMI a little bit lackluster, but that drawdown in crude oil could be giving people a little bit of oomph, and especially those new home prices. I mean, it was 9 percentage points higher than what was expected on those new home sales. So that was pretty massive. All right, so let's talk about a couple of things I'm looking at. EWZ still playing this to the downside. Now, there's something I really want to talk about here, and it has to do with regulations and all of this other stuff around our trading accounts. In an IRA, you're really not allowed to sell naked short calls, right? So we're kind of handcuffed a little bit in that we have to create spreads in there, have a defined risk strategy, because the regulators feel that is a lower risk strategy. Well, it is a lower risk strategy, but it is also a lower probability of success strategy when you're doing a spread. For instance, in this one, it was on the 10th, I believe, when we got this confirmation of a sell-off. Now, I had high implied volatility right in here. Volatility was relatively elevated. And then EWZ, yeah. I got a bit of volatility coming out on this. It worked out quite nicely, but then I got the move higher. Came up, tested the Fibonacci resistance area. Now, if you guys remember my IRA, I'm short the July 42.43 call spread. I originally sold it for 33 cents. Now you can see the market's come off. Volatility is probably a little bit higher than where I was when I originally got into this trade. But what I want to talk about here is the theta decay. The volatility really, let's call it about the same. We're relatively in or around the same pricing area. I sold that 42.43 call spread in there for 33 cents. It's a third the width of the spread. That's what I'm looking for in this type of trade. All right. Now, at the same time, in my trading account, I sold the 42.5 calls for about 80 cents. All right. Now, during this time, that short call spread that I sold for EWZ, sold for 80 cents, is trading right around 20 cents right now. So I've seen about a 75% reduction in my premium on just those short calls. On the flip side, that call spread, right? It's had to be a little bit more aggressive to get the credit, and I only got a credit of 33 cents. Yes, I know my limit is 67 cents on a loss, but the probabilities of me being out of the money on just my short calls is much better. And I got paid off faster. Yes, my risk is unlimited to the upside, but the beauty in these short calls, and I'm going to really drill down on this Thursday, is yes, the regulators say that the short call is more risk, and I'm not going to lie, it is. But the probabilities of success with the short call versus the short call spread are so much better that you can see on the trade that I sold for 80 cents, it's trading right around 20. That is a much better return on investment than my trade that I basically sold the 42, 43 call spread in there for 33 cents and it's trading around 20, right? So, you know, that's why I lean towards doing these naked spreads. I believe that the higher probability is trumps the risk aspect of some of these things, generally speaking. So I wanted to talk about this because we are going to really drill down on these details Thursday on this short calls webinar. And I'm going to probably be using this as an example. All right. So keep your eyes out for that. Go to protraderstrategies.com, sign up for the webinar. We're doing a whole series on swing trades. We look at what a swing trade setup looks like, and then we're going to find that option strategy that best fits that assumption and everything that's going on in and around that underlying. All right, and booking, getting a bit of a bounce here. Now, something I'm going to be keeping an eye on here. I was expecting a little bit more of a better settlement yesterday, but we did test that support level that I talked about yesterday. It lines up with my other Fibonacci on a different chart where I've anchored them to different areas. This is a fib. So I'm going to keep an eye on that. You can see it's happened time and time again where it's bounced on that. So it is a solid support level, probably more so even than the Fibonacci that I have up there. Anyway, we're just getting a bit of a bounce, but I want to see a settlement above this 22.14 area. Let's call it 22.15 is a settlement I want to see because that gets me above that line in the sand of my Fibonacci that, you know, is anchored to the high. So to me, that's something I want to get back. And then we look to come back to the magnet here, which is the point of control. All right. So it's trying to draw it up here. We're getting some momentum moving. So hopefully we can get above that Fibonacci and we should pop right back to at least the 50-day simple moving average here or that point of control. I'm more looking for that point of control for this trade here. And that's about it. Those are the couple of things I'm keeping an eye on. And wait and see for tomorrow because tomorrow is a really big day because we're going to be getting the flash estimate PMI numbers. It's a purchasing managers index for the European region. We get our ISM, which is the Institute for Supply Management prices paid. That's going to talk about our inflation there. So keep your eyes out for that. Manufacturing PMIs tomorrow for the flash estimates across the pond, and we get our manufacturing PMIs. So big day for data tomorrow. Stay tuned. We'll talk about that and how it's going to be impacting the markets, and hopefully we can come up with some strategies we can implement. All right, that's all I got other than, you know, hit that subscribe button if you're new, you want to learn more about trading, investing, stuff like that. Also, questions, comments over there on the side. At the end, we're giving you guys a link. Please click on that. It'll take you to those. I believe it's taking you to the webinar on swing trades. So check that out. We're going to be drilling down on the short call this week, and I'll tell you all those details there. That's all I got for you guys. Other than if you can't smash that, take that. Nailed it. Take care. And take it easy.